$2,300. It's only April and we've already got our third record-breaking move from gold. What is going on and why is it sending the price of gold up, up and up again? Let's find out. In this very short rundown, I'm going to take a super quick look at the recent rally in the gold price and why it happened and who's behind it. Of course, you could save yourself some time. Just head to any mainstream website because they think that they have this nailed. Every time there is a change in the gold price, they just look for the most recent chatter about Federal Reserve rates and boom, that's your answer. That's why the gold price moved. But this isn't the whole picture. The price of gold does not go to 2,100, then 2,200, and then 2,300 in a matter of weeks because some central bankers muttered something about rates. The truth is, the gold market has become less and less responsive to sentiment regarding interest rate. In 2021, the correlation has broken, and this is where the phrase correlation does not mean causation comes to mind. The gold price is not holding above $2,000 an ounce because of US interest rates. Yes, it might have a quick pop up or down every now and then if a central bank makes a suggestion about where they'll go next. But that's not what is giving gold its long-term strength or what is pushing the widespread desire to own physical gold. Gold has been climbing in price for a long time now, but something has shifted in the last year or so, which suggests to us that big changes are afoot. Exactly where this demand is coming from, there are a number of options. Is it the institutions? We know gold demand is probably not coming from institutional buyers. In fact, much of gold's strength in the last year has been in spite of institutional demand. Gold-backed ETFs are the institution's vehicle of choice when it comes to increasing gold exposure, and ETFs have been experiencing outflows for the last 9 months. Just in 2024 alone, outflows from global gold ETFs have piled up to $5.7 billion, and this is largely thanks to the US and Europe. It would take a pretty big epiphany and buying for institutional demand to do a 180 and buy enough gold to make an impact right now. So consider what we are saying. The gold price is doing this well without the support of Western institutions. Speaking of the West, what about Western demand for physical gold from the likes of retail buyers, high net worth? Maybe, but prior to the pop-up over 2,300, if anything, bullion dealers were seeing a push to sell from their clients rather than buy. Now, since April 3rd, we have seen a significant uptick in the demand to own gold, but that wasn't what got us to 2,300 in the first place. That happened before Western investors turned bullish, so we can't attribute much of the increased demand for gold here. And then what about not in the West, say central banks elsewhere? Here, I am very bullish about the fact that this could be a source of the uptick in gold demand. I think central bank gold demand in the last few years has been the catalyst in the wider financial system that will ultimately be the shift in the economic paradigm that we have so urgently needed. It is no secret that central banks, predominantly outside of the West, have been increasing their gold reserves. It is very likely that official gold reserves are not being bought by official or traditional routes. Everyone agrees that the motivation for central banks to own gold right now is strong. For instance, we note that in the last 2 World Gold Council surveys of central banks, one of the options that when central bankers were asked why banks decided to own gold was part of de-dollarization policy. And I'd go as far to say, I think that this is more of a factor than anyone lets on. Officially, central bank demand was down slightly in February, but we still saw the 9th consecutive month of growth. China and India continue to be at the forefront of central bank gold buying. But remember, China hasn't always been so forthcoming about its gold purchases, so I would look at the official numbers as a guide. But of course, Chinese demand is not just down to the People's Bank of China. The mentality towards gold ownership amongst locals is very different to that in the West. Amazingly, February saw 127 tons of gold leave the Shanghai Gold Exchange, above the 10-year February average of 118 tons. That's not a bad thing. That's likely gold going into the local market, and this was the second highest February wholesale gold demand since 2017. We have also heard anecdotally that much of the gold outflows we have been seeing from gold ETFs in the West have been making their way east. Again, though, there is an argument that none of these numbers account for the support gold is currently experiencing. Like the PBOC's gold reserves, overall gold numbers in China can be kept on the down low. And then what about India? The other country we can usually rely on to think sensibly about gold. Interestingly, though, the thinking around price is quite different to that in China. Whereas in China, a high price can usually take to mean that there is strong demand or a supply shortage. In India, a higher price can often mean we are going to see a drop in demand. Having said that, the World Gold Council has reported that it still expects to see domestic demand increase by 100 tonnes this year to between 8 and 900, which would be the first increase above 800 tonnes since 2019. But is this enough to have seen such a surge in demand for gold and support for the price recently? We're not totally convinced. Okay, so what about the good old paper market? Speculators definitely have a role to play when we see spikes in the gold price, but there isn't anything funny going on as far as we can tell. The futures market is pretty transparent, and we see little evidence of anything in the CFTC data that convinces us that this is where the demand is coming from. So what is going on? We've asked around and we've read around, and like all good stories, there is no clear conclusion here. We posit that the strength in the gold price and gold demand is from very high quality, serious investors. Whether they are central banks, who can really tell? But the fact that gold is behaving in this way, in spite of all that is going against it, strong dollar, good US data, and so on, suggests that we really are at the start of something very exciting indeed. Of course, there is every chance that it will continue climbing towards $3,000 or beyond, and this relies on several pivotal but not ridiculous factors. Firstly, any escalation of geopolitical tensions, including areas like Taiwan, the Middle East, the Russian borders, Korea, Venezuela, among others deemed predictable, would prompt investors to seek refuge in the safe haven that is physical gold. Furthermore, deteriorating financial conditions coupled with the effects of interest rates, such as widened spreads due to increased corporate defaults, would also drive up demand for gold. Lastly, repeated and increasingly dire warnings regarding the fragile state of the US fiscal position would only bolster the confidence of the bullion buyers. And with that in mind, I highly suggest that you check out one of our other videos to find out what else is going on in the gold market and how you can take advantage of it.